After the stock market turmoil and a nearly 9% drop in exports last month, China's central bank did what economists say it had to do: allow its currency to depreciate. The move makes Chinese exports cheaper, but it does so at the expense of foreign companies doing business in China, says Jasper Lewis at CMC Markets.
Now, relatively, those exports are going to be more expensive inside China. Likewise, Chinese exports are going to be relatively more cheaper. And so that's a disadvantage to these companies that were already highlighting difficulties in their business in China because of the slowing economy.
The lower yuan boosted the value of the dollar, sending dollar-priced commodities such as oil sharply lower. But some say the long-run benefits of a healthy Chinese economy outweigh the short-term impact to developed countries like the U.S., says PNC Financial Services' Gus Fauché on Skype.
I think this is a short-term hit to the United States. Over the longer term, I think it's a positive for the U.S. And I think the U.S. economy is fairly well positioned to absorb this.
Fauché says that despite the likely drag on U.S. trade with China, which represents about 1% of U.S. GDP, the latest currency move helps rebalance the global economy. Others, like Hong Kong investment strategist Francis Lun, wonder what all the fuss is about.
Frankly, 2% really doesn't mean anything, basically. If you have a 10% devaluation, then it might mean something, but 2% devaluation, it has actually minimal effect on the economy.
But analysts worry there may be further devaluations. And for Chinese consumers or investors holding on to Chinese assets, the effects are bound to be greater. Arcega, VOA News, Washington.